Another thing is about the inflation level in 2025. Yeah. As you mentioned, that many of the policies that Trump has announced, if the campaign promise are very inflationary, his international trade policy, his immigration policy. So do you worry anything about the inflation level?
So I would agree that tariffs are inflationary, and it just depends on how big are these tariffs, and so they're definitely inflationary. I really would mostly worry about the tariffs. Now the tariffs are, we think of that as a one-off price level shift, right? So it's a one-off increase in prices, and then provided you don't keep doing it, then the prices come back down, and it shouldn't, in the long run or medium term affect inflation. In the short term, it does. Right, so we have, for instance, only China tariffs in our forecast right now, but that already generates about 30 basis points of extra inflation, and that's the difference in the U.S. between landing at the target and landing at about 2.4%. So it's not nothing.
You mentioned the tariffs on China. Many investors concerned about the 60% of the Trump administration on China. Do you think he will really do that, or is just a short-term phenomenon, or it's just a negotiation tactic?
We don't know, but the reason we have 60% in our forecast is because we had to make a decision. So 60% was, I think, a campaign number, right? But so you don't know whether you're going to get 60%, but we had to assume something. So we put 60 in there for now, and then once we get the announcement, we'll have to revise it, right? But so I take the China tariffs very serious. I'm not really in the camp that believes that this is just transactional and there's some quick deal to be made. It's unclear to me what the deal is that the U.S. would be after. But so those tariffs, I think, are definitely going to happen.
Do you think this time China is better prepared?
Well, I think it's better prepared in the sense that businesses have continued to diversify their production base, right? So I think that makes it somewhat easier to circumvent the tariffs, although the U.S., I think, is also very aware of that, and so they'll try to enforce things like rules of origin, right? So the
universal tax.
If, for instance, a good from China goes to Mexico and then into the U.S., they may have a requirement on the Mexican content versus other content going into the U.S., and they try to enforce that. Now, I don't think that's that easy, but so in that sense, I think China is better prepared, because last time the end result was that Chinese market share in the U.S. went from 22 to 14%.
Yes.
Right, and if you have something that is now much larger, you could lose all market share, right? You could really, really sort of have a lot of damage. So I think a few things will have to be different. We don't think the currency is a big variable, because I think it's too dangerous to sort of try to use the currency to do that. In my mind, it's going to have to be support for exporters. I think you need to help consumers. I think you need to put a floor on their consumption to sort of maintain a critical mass and momentum. But so there's lots of things that, and then I think retaliation is the interesting one. We, of course, don't know how the government will respond, but it's sort of very difficult to figure out what the optimal retaliation response is, right? And so those are all things that are going to affect the distribution of sort of the cost of these tariffs.
now it's the start of the 2020. What are the top three things?
So for me, I think this distortion in the U.S. bond market is creating opportunities elsewhere. So I would want to buy European bonds or UK bonds, for instance. The other thing that I think is still underpriced is sort of the volatility and the risk. So we like buying volatility. We like buying gold, right? Those are things that are sort of attractive. I would say fixed income, gold, volatility, and then U.S. equity.
So what are the three things that investors should steer clear of?
Well, stay clear of the things that are too consensus. Right now, I stay clear of markets that are very volatile. What else would I stay clear of? Anything that has any kind of sort of tariff exposure.
Maybe in the year 2025, the half year will be more dramatic than the second half. Because he inaugurated 100 first 100 days.
That's sort of the way we model it. So even if these tariffs are not implemented until later in the year, which we think is possible, the market reacts very quickly and then it moves on. It recovers potentially already by the time the tariffs are implemented.
So the first half year will be more volatile.
Yeah. I take the China tariffs very serious. I'm not really in the camp that believes that this is just transactional and there's some quick deal to be made. I would say fixed income, gold, volatility, and then U.S. equity.
How to boost the sentiment? What are they waiting for? How? At the end of last September, there is a dramatic turnaround of Chinese policy announced. So do you think it's a tactical move just to cushion the outside pressure or a strategic one to make our economy more sustainable?
My interpretation of all the stimulus that's been announced since last summer is that the bulk of it is related to dealing, I think, with the property market slump, right? Yes. And it's been a lot now that's been announced, right? It really has added up to pretty significant stimulus. And so that's structural. That's not something, I think that's dealing with the problem. I think there's more to come, hopefully. The problem, I think, from our perspective, is when you look at how much is the property market dragging the economy down and how much could the tariffs drag the economy down. If you add the two up, we think they're worth about 3.5 percentage points of negative growth, right? So it takes 3.5 percentage points off the growth. The stimulus, as far as we can sort of add it up, is about 2% of GDP. So we don't yet have enough stimulus to offset property and tariffs. Now, we don't know what the tariffs are going to be, right? We could be wrong on the tariffs. The tariffs could be lower than we expect, and then maybe the stimulus is enough. But that's sort of, I think, the bit that's still, and the government, I think, is partly sort of waiting for, and that we might get then in March at the MPC. But so that bit, I think, still needs to be calibrated to the tariff shock.
Property market is one of the two big headwinds in China. So it's been in the process of correction for about 3-4 years. Yeah. How long will it take?
The recovery, the actual bottoming penciled in for 2026, so first half of 2026. To be honest, I think there's enormous uncertainty around that. I mean, it could be much earlier. I'll give you an example. So we this year have the property subtracting about 1.5 to 2 percentage points from growth, and then last year it was about 2.5 to 3, and next year it's about 0.5 to 1 or so. But these are all guesses. For instance, November national sales data on property was positive year on year, right? If we start to see a couple of months of better data, because a lot of this is about psychology and what people believe, and if people sort of believe that we've hit the bottom on the prices, then demand will very quickly come back, because then people don't want to miss out on getting sort of the low point in prices, and then you can get into a virtuous circle. Right? What we're doing in the forecast is to some extent extrapolating from a lot of the weak data that's just behind us. If you ask me, what is the upside risk to our forecast? I think we could be way too pessimistic in our forecast on property, and we could be too pessimistic on the tariffs, right? And I think so both things could give you a much earlier recovery than we currently have penciled in.
Another thing is the domestic demand. And our government has made it very clear that to boost the consumption is the first priority in the year 2025. How?
First of all, I'd say it's not as weak, I think, sometimes as it's made out to be, right? So if you look at, so one thing that happens when people don't spend on property, they have a lot of money to either save or spend on other things. And when I look in real terms at sort of spending per capita, per person in China, it's not that far below where it was in 2018-19 in real terms. In nominal terms, it is. But actually, the levels of spending in real terms aren't so bad. And the service sector, I think, is doing okay. What could you then do? I mean, there's so many different ways in which you could help consumption. You could obviously do, you could do more in terms of the trade-in schemes, like upgrading sort of the type of goods that people have. You could do a variety of things through tax cuts, et cetera. But we don't know yet, right? So we have not spelled out in any detail what exactly we think is going to happen to help the consumer. But there's sort of many standard ways in helping the consumer.
How about the sentiment? How to boost the sentiment?
I'm an outsider. I'm a visitor, right? So, so I'll tell you my impression is that sentiment is better now than it was a year ago.
Yes.
Right. And in part, I think because there's a lot of action has been taken since the summer. My team does that, and they track that, and it actually adds up to quite a lot. And so when the government signals very clearly that they are very aware of the issue and they're dealing with it, I think that's sort of sentiment enhancing.
You said that the market sentiment here is better than 1 year ago, as you said, especially after the policy turnaround in last September. So I see that many international investors are still in the wait-and-see mode. So what are they waiting for?
Partly the tariffs are enormously important. You just want to understand what's happening. So if you're a portfolio manager and you have to go to your investment committee, and let's say today you start buying Chinese equity, and then next week Trump gets inaugurated, he announces a 60% tariff, and the market goes down. That is not a good career decision, right? So the fear of the unknown makes it very hard for individuals who are accountable to investment committees to sort of explain why, before they even knew what was going to happen, they wanted to buy the market, right? And so I think that's a problem. I know plenty of investors who are invested, right? So I think there are some very, I won't mention their names, but there's some very well-known investors that are sort of famous who all like Chinese internet stocks, right?
Yes.
So there's certainly, I think it's sort of easy to identify pockets of value in the market that people are actually invested in. The other thing that I'm sort of surprised by to some extent is how well the currency is doing. So, and I would also say it's not just China, right? It's also, you have to be careful sort of not to, when you look at sort of the price action in individual market, think that, it's all about sort of what's happening in China. Right now, emerging markets, everything is under pressure. These U.S. Treasury yields going higher, the dollar being stronger, oil being higher is basically a perfect storm, right? And so everything is under pressure.
Thank you, Aaron. Thank you very much for your time.